Well, good morning, everyone. This is Glenn Thompson, and thank you for the comments that I've just observed on the control panel side of the screen. I'm glad you're here. I just hit the recording button, so we're ready to begin, and we are recording as typical. So we archive the presentations, and so once again, if you'd like to review any portion of what I say, or if you come in late, we have it recorded for that purpose. Welcome, happy holidays everyone, and good to be with you. The future course of the dollar is today's presentation, and my name is Glenn Thompson. If you are attending for the first time, I've been doing webinars for almost 3 years now. Prior to that point, it's been a while, but in any case, good to be back. And about a year ago this time, I presented I had a presentation where we talked about my projections for 2015. 2015 has been a year marked by tremendous volatility in various capital market sectors. I don't expect the same degree of volatility as we move into next year, 2016. I would, if anything, characterize my projections for next year to present regime changes in the financial sector globally. So that whereas this year this year I have immediately, we saw in the first few weeks of 2015 evidence of tremendous unprecedented volatility in various sectors, in the Swiss franc, in the US currency, in the global stock markets. Next year, I think, again, will mark significant turning points and reversal points and pivot points across different sectors globally. Whenever I think about a currency, a starting point, and I'm, from a fundamental broad brush standpoint, is to imagine the currency as being the offerings of a company. If we can imagine a sovereign state or a nation having issued stock, its currency would be its stock. So that's typically the broadest starting point, or the vantage point that I start from when I'm trying to gain a sense intrinsically of where I expect and how I expect a particular currency to travel over time. And as such, I've started my thinking about that with the dollar. The fifth year of every decennial period for equity prices, typically going back for hundreds of years, has been known as a year of ascension from a cyclical standpoint. And I think and it remains to be seen, but we have ascended even in light of yesterday's significant decline as a percentage in the stock market across the board. I do believe we will end the year at higher prices based on some specific parameters that my analysis has projected. So that's kind of a quick overview, folks. Again, for those of you who are attending a presentation I've given for the first time, as you see on the screen, I'm Glenn Thompson. I've been teaching with folks at Pacific Trading Academy and consulting and doing that related work since they began about almost 16 years now. I guess I've been so used to saying 15 years, but I forget how we move forward through time and the rate at which that occurs. But it's been a while. I've been actually trading starting back in the New York metro area, I guess on the order of 34 years now. So again, as the fate of a nation state goes, so too does its currency. And I think moving out into the next year, as I was thinking about a topic that I thought would be appropriate to kind of characterize the various capital markets domestically and globally, I thought to present my recent thoughts on the course of the dollar would give us a good starting point. So with that note, let's proceed. Let me move that over. Oh, yeah, I will. You have room on, as you can see, you can write your questions in on the right side of your screen on the control panel, and hopefully I will, for the most part, I'll address them at the end of the slide presentation. This is a rather short one normally, and I always say that, and I always talk longer than I hope to. I only have about 13 slides, so normally I have anywhere from 20 to 30 slides. So I will be amazed myself if I go over. So I say that to say I expect I have plenty of time for any questions that you may have concerning anything related to what I'm discussing. Those of you who would like to learn more about Pacific trading and or specifically what did I do in that context, you see our contact information. You have our phone number, the toll-free 800-339-8588. You can also take a look at the website. I haven't written some blogs. Ideally, they wanted us to put at least one blog up per month. I have been a little remiss in that. I've just gotten busy in the last few months. But barring the last 6 months or so, I was pretty much writing 1 or 2 blogs per month. So you can see some samples of some of my views over the years if you probe enough deeply into the site. Peter Newman, who I'll mention at the end again of today's presentation, is Dean of Admissions and handles any serious inquiries. All right, let's move on and let's see what I have cooked up for how I expect the market's going to move, the dollar, that is. I always start with the dollar. Well, if you think about any currency, but the dollar and the U.S. in specific, ultimately, to a large extent, it varies more or less, not perfectly, but to some extent, it's certainly not an inverse relationship. We want to look at GDP, and that's fundamental. By the way, folks, so if you are new to my presentations or if this is the first time, I am primarily a technician. But you know, interesting irony, I started my career, the very first book I read to get me up to speed in this business and as an intro into where I have come at this point was a book called Fundamental Analysis by Benjamin Graham. And I always tell the traders that I consult, it's ironic that 30 plus years later, I don't do much of that, but that was my starting point. I always tell people, if we're thinking broadly, whether you consider yourself to primarily depend on the fundamental form of analysis, a technical, which is merely price-based, or a quantitative, or a cyclical, these are just varying types of information. Information is information. The title that we give to the type of analysis that you and your analysis in your efforts to locate value areas in a market often gives us context. I think in what is soon to be 2016, an amalgam of all types of information will serve your efforts to most frequently maintain a high correlation for locating, probability good value trades. So whether it's fundamental in nature, cyclical, time analysis, seasonality, whatever, technical, which are more chart-based, I think an integration of all of the above, such that when information of different sources which has different origins, when they tend to converge, that tends to provide a strong indication you're on the right track analytically, and you can correspondingly have a greater degree of confidence in the conclusions that are mutually arrived at or via different information streams will lead you to. So whether it's fundamental, so again, I start with that broad fundamental scope and vantage point in view. GDP of a nation, we want to look at that, and that's why the entities within the broader economic framework of a sovereign state like the U.S., we issue reports like GDP numbers, consumer confidence levels, unemployment, job reports, etc. All of these things are components and parameters to which a currency is quite sensitive and pays attention to. So the slide here just merely points out some standard interesting relationships between some of the different sectors. I'm bullish. Let me just state at the outset, at least going out for the first quarter of 2016, I expect strength in the U.S. Dollar, in the currency. We've got a Fed meeting coming up Wednesday. Those of you who have talked to me in the last 2 weeks or so, at minimum, know that I have projected a major turning point in time, a transitioning point for the equity sector, the stock market, to occur a week from yesterday, next Friday, the 18th, I think that is. Yeah. So essentially, I consider that projected theoretical time target to be one and the same, or to be closely aligned with whatever information is a result of the Fed meeting this coming week. There has been talk for months, as many of you I'm sure are aware, that about, well, it's more a question of when we are going to see our initial the first increase in interest rates for years. It was at 8 or 9 years or more, for which we have been in a low, very, very low interest rate environment. So the market, all markets, the dollar, the interest rate bond market, the credit markets, and equities, and of course, are constantly, in varying ways, sensitive to proceedings from a central bank and the monetary policy. I have maintained for about 6 or more months that we would not see an increase in interest rates until 2016, the first quarter of next year. We had a very positive report. I guess the last jobs report was strong, relatively speaking, on the surface, and that would provide that, I guess, has given recent impetus for some of the financial pundits to increase their expectations that we may in fact see that increase sooner rather than later, possibly at the meeting next week. I hope the Fed, this is my personal kind of viewpoint here, I'm just kind of sharing my thought stream. I hope the Fed does the right thing and does not, in my estimation, doesn't or delays interest rates. I would be surprised if that is the case. I don't know if they will cave into certain expectations, but bottom line, we shall see. I'm not solely in the business of prediction. I'm in the business of speculation. Analysis is a component of that. So we shall see. So and that's actually a good segue for me to indicate why, after having started my career in the fundamental front, in a regime of consideration of fundamental factors, why did I transition to a technical approach? I simply cannot make consistent sense of the plethora of fundamental information if that's all I were looking at and trying to figure out. So I found personally years ago, when I began to more and more greatly incorporate a technical chart-based analyses to integrate with the fundamentals, I could more often than not clearly get a clearer sense of plausible projections and pathways for markets to move. And then so that's the order of my analysis. I typically start with the charts and timing in particular. Those of you who've heard any of my presentations know that. And then that creates a more distinct predisposition of expectation as to the type of events fundamentally that would need to occur that would be consistent or aligned with my favored technical prescriptions for the market or projections or prognostications. So okay, so following on my expectations, let's say out into the first quarter of next year, I'm expecting appreciation in the dollar for whatever reason. Whether it's based on an actual increase rate hike, 25 basis points coming up this coming week, or whether there is no increase in rates at this meeting, but maybe it's into the months to come in the next year. I do expect, based on fundamental considerations, decreasing a slowdown or continued slowdown in global growth, China, India, Europe, US, across the board, continued slowdowns in growth. And that's part and parcel, one of the factors overall, in a very macro way of thinking about this, as to why I said what I said a minute or so ago about I hope that the Fed does the right thing. What I consider to be the right thing right now is continued dovish monetary policy. I just don't see that there is data sufficient fundamentally to warrant an increase in rates currently. I know the reasons why, the arguments for deficits and so forth. We are in a regime, we are in a world in 2016, especially, I believe, where perception will override reality. To the extent we can bolster by any means within our conception confidence overall, consumer confidence, all types of confidence, and to the extent we can continue to use the governmental printing presses, as it were, I think that is the lesser of the evils. That is a medicine, and certainly there will be side effects, metaphorically speaking, to that medicine. I'm not not the ostrich that has a head in the sand and oblivious to the deficits and the account deficits and these types of problems, systemic not only in our economy but globally. But in terms of the easing we've seen, I just don't expect that. I don't see sufficient countervailing forces in terms of increases in GDP, confidence, job numbers, etc., that warrant an increase in cost of money at this time. However, I don't know that I think the market wants it, and the question is whether or not, when I say the market, I mean primarily the stock market is what I'm referring to. And until such time as we get it, that will put pressure on stock prices or equity markets, and particularly here in the U.S. is my kind of view, broad view. So in a sense, here's what I predict kind of short term for the next few weeks. I expect, to the extent we continue to delay, and I don't know if it's going to be a delay on the order of days if the Fed does raise rates this coming week or begin a regime of rate hikes, that I expect would be interpreted by the equity sector, the stock market, S&P, the Dow, etc., as a positive thing, because the markets, more than bad news, markets hate uncertainty. And so to the extent they get that long promised increase in rates, I think that would be construed as a positive by the equity markets in the United States in particular. If we don't, that could serve as that would call in the additional selling. And so what we saw yesterday in the stock market, I expect to continue into the mid to latter end of this coming week. Again, my time target for the stock market to reverse or have a significant transition is a week from yesterday. That's December 18, which I am tying in integrating very tightly and intimately with whatever emanates from the meeting this week from the bank. If we don't get, if bottom line, what it manifests this week in terms of the bank policy is a furtherance, further delay, I think that would be the impetus for further declines. I can see how the market would react negatively to that. If we do get a hike, I can see the market reversing to the upside. In other words, what normally in a vacuum, in a sense, in a theoretical isolation way of thinking about it, if we, I think we're going to see the odd or the atypical relationship or reaction that we would normally expect. So what's normally considered to be price oppressive or put pressure on stock prices, I think here in this case, which would be a rate hike, I think here it would act as a stimulant and buoy and bid prices higher. So we shall see. In any event, if and whenever we get an increase in rates, and even if and until such time as we do, the promise of such, I think, will be price supportive for the U.S. currency. So that's my point. The expectation and the actuality of an increase and thereby in cost of money and thereby a decrease in money supply will be price supportive for the U.S. currency. So that's my overall big picture way of thinking about how the dollar in particular it will respond to an increase or a regime that is more bullish or more hawkish in terms of monetary policy until such time, and I think that's what the dollar is looking for, and we will get it. And so let's go to the charts to kind of see if we can see if there's support for that overall fundamental premise. Timing should always take precedence over price. That's my technical view. That's the GAN analyst in me, and so the underlying concept here is a market's going to do what it's going to do once its time has come to do it. From a more fundamental idea here, I'm always looking to see if different theoretical precepts, in spite of their differences, coalesce and find nexus points. Money flows towards greatest rates of return. Another factor, the reason I wanted to explicitly focus on this money flow idea is whatever weaknesses we see here domestically, especially when we're looking at Forex or anything related to currency trading, we've got to look at it in the context of what's going on. We're not in a vacuum. So I look at, last year this time I was extremely bearish on dollar, I was bearish the yen or bullish on dollar yen, and I think that's a reminder of the necessity of how you cannot look at any given currency in isolation. You've got to look at it. So I look at the major sectors. Probably next year might mark a transition and a transformation vis-a-vis what I mentioned a minute ago about regime changes. As far as the yuan, I started to include a slide. At last minute last night, I was trying to think about additional, possibly even esoteric relationships that might further impress or the idea of what I'm expecting the dollar. And I saw a tracking or an interesting correlation between the Chinese renminbi and the U.S. So it's out of phase, but I decided not to because I couldn't quite. That it would have obscured some other more important central points. But I do think, I bring this up to mention, I do believe that we'll see more and more obvious, curious, the yuan is going to be more of a critical factor in the year to come, I believe. And that certainly will have ramifications for the U.S. currency. But its current pegging to the dollar is of interest right now, and I see a very interesting correlation there as well. So money flows towards greatest rates of return. So this is important to watch as we watch developments in the ECB and in Asia as well. All right. So here's my technical assessment of where we are and why I expect the market's going to move in the way and why I'm bullish on the U.S. If you look at, here's a monthly chart, long-term chart going back 25 years to 1990. Up to this point, number 5 on the screen, that's the end of a generic bull market. And so this is just a wave count that I've done, and I want to give you a little bit of a description in terms of some underlying descriptive technicals that account for my view. That top there, a high price over 120 basis. This is again a long-term chart of the U.S. Currency. That occurred, when was my date on that? What was that? Back in, is it 2001, I believe? Yeah. Okay. And so that marked, from a wave perspective standpoint, the end of the generic bull, and marked the onset simultaneously of a generic bear market. And I think we've been in a bear market up until, say, the end of about the end of 2014. And so bear markets typically, theoretically at least, should take the form of an ABC, a 3-wave pattern. So your A wave, once this top came in 2001, this is the A wave. A wave should break down into 5 separate waves. If you can see that, here's the 1, 2, 3, 4, 5. For those of you who understand Elliott, if those of you are if I just lost some of the viewing audience, don't worry, it's not important. I'm not trying to, this is not a treatise on Elliott analysis. It's an idea just to illustrate some of the components of a argument for why we're bullish on the U.S. So if this is the A wave here, that came in March of 08, this little bottom right here. I didn't mark the dates, but I know them, and you can kind of interpolate if you see the time window down here. These are just in years. As you see, this is a price time plot, just going back about 25 years or so. So this is the bottom March of '08, the end of an A. This is a triangular B, curious, and that's part of the reason why I have confidence in this description is we see about 70%, the frequency of occurrence of triangular type corrections often is in B waves. And so you can see triangles themselves must consist of 5 waves, A, B, C, D, E, A, B, C, D, and then E. Those are the 5 internals of a B of a larger triangle of a larger ABC itself. This can get a little hairy in terms of the details, the levels to which one can drill down and in an effort to locate the internal structure that the theory suggests must be present to confirm a particular count. But in any case, that's the B, I believe. That occurred at, what was that, August of 2012, marks the end of this top there, which at the time would have, on a shorter time frame chart, would have seemed somewhat significant. But that's the end of an internal B wave of a larger ABC bear market. The C, you have a kind of a quintuple bottoming area marking the end of the broader bear market itself, I believe, which I'm going to say the lowest price came in September of 2012, marking the end of a generic bear market. So everything from back further, I didn't go back and mark off explicitly the ways constituting and creating the bull market. I could have, I didn't want to, I want to focus more on more recent price action. So this letter C indicates the end of what my analysis suggests was the conclusion of a generic multi-year, long-term cycle. Bear market, in fact, the bear market starting up at number 5, back here in 2001. So from 2001 all the way through 2012. So essentially an 11-year bear market here. Interesting. There tends to be some degree of symmetry in terms of amounts of time that markets spend in different phases of their regimes, whether it's a bull or a bear. So I want to take that into account. If that's the case, if we had the conclusion of a generic bear market occurring September of 2012, 3 years ago essentially, I believe at that juncture we started the new generic bull market about 3 years ago, just over 3 years ago. September of 12 marks the end of the preceding cycle, 1, 2, 3, 4, 5 ABC, and marks correspondingly the onset of the new bull market. And I think that's what is going to bring us to where we are at this moment. All right, if that's the case, I believe the 1 of a particular degree began at that same time. 1 would end up at this top here. I didn't mark this top is coming in. I do know the times in my head. If I recall, that's going to be about December of a year ago. That's about a year ago, the last December of 2014, this little top right in here. 1 year to this, kind of probably to this day, roughly given a plus or minus a week or two, I'm guessing. That's your 1. All of this area in here is your correction 2. That's your May, that's the last spring, May of 2014. Oh, I'm sorry, wait a minute, yeah, December. That's going to bring you into May of 2015, excuse me. And then everything from that bottom up to this top right here, that's number 3. Okay, so 1, 2, May of, okay, this is the end of December a year ago, this top, the end of what I'm considering the start of a new bull market, wave 1. This would be wave 2, last spring, May of 15, and up here is the end of what looks to be a 3 within a third wave, March of this year. Okay, March of 15. So that's a big, that's a long-term chart that we see, the monthly, and that's going to bring it. And so I'm going to scale down. Let's drill down to the next weekly and see a kind of an internal look at that. If this is the 1 right in here, this is the end of wave 1, which is December of 14, as I said, right up it here. This is just this is the weekly chart. I only go back about 5 years here. This is the end of the C wave, right here. Remember we said from the preceding. Let me back just so you see the overlap here. This C right here is the same data point where these set of bottoms here. I'm going to hone in on that a little more precisely on the next slide. This is the same data point as this point right here, September of 2012. That's the end of the bear market in my estimation. Everything since about September of 3 years ago up to this top right here in 2014, that was your one. This, and then you see the price action consistent with a correction 2. A little odd triangular structure internally, but again, remember this is a weekly chart. And this is wave 2, and if that's the end of 2, it's the start of 3 up to this top here, which we said was March, the fall of this year, March of 2015. All right. So if this is the 3, the end of 3, it's the start of a 4. Ostensibly, everything from the top March of 2015 being the end of a 3. If that is if there's anything to that, then you see A, B, C. These are the internals of what would be a could be a fourth wave. Maybe. If you, one other point I want to go back to, from a scale, so as to not mix and match apples and oranges or scales. In other words, I didn't state this explicitly. I want to come back and state something more so it's very clear. This bottom, even though I said this this would be the start of a 1, yes, but it might also be it's the start of what could be a larger everything. This could be the 5th of a 3rd. All of this could be a smaller degree. Everything, this ABC bear market might itself be a 4th wave of a larger degree. In other words, this is the bear market A, B, C internal of a larger degree. If we're going back 20-some years, again, putting this into context, if this is the start of a 1, no doubt it is, or it might very well be, but it might be the smaller internal one of a larger 5th wave. This being the 5th of the commensurate 3rd wave, and this be everything from this number 5 down to here is your bear market ABC of the larger 4th. In which case, this what I'm calling the 1 on the next chart could be the internal 1 of a larger 5th. All of these internals. So that's one of the tenets of the scaling component and of the Elliott model. But so in any case, for focusing on any particular scale or degree of observation you as an observer would be curious about. So that depends on the context and what you're looking for. But in any case, I see structure consistent with this description or this count. This would be a 1 here. This would be our 2. And this brings us up to a particular 3rd wave. And I think everything, and this is again the top March of this year, March of 2015, right here. And then everything, this is August 24. We all, I'm sure, remember that, at least if not on the dollar. Many of the markets, not just the financials, a lot of the derivatives and commodities had major swings on that 824. But if nothing else, those of us who follow stock markets remember the big decline we saw on August 24. It actually began August 18. I know because I had a time target August 19, and we shorted the market. It was one of my better plays for this year. So timing is, and that gets to the reason I mention this is to again illustrate the additional benefits that and understanding that timing and the role that timing has, more to the point, in the sensitivities that markets have often to certain specific elapsed time periods. The extremity of this move, why it's so salient on from a standpoint of observation, is because its time had come. It actually came right. I had projected the day after, but it came in on that's the 18th. I know that because it was very real, and you'll see that when we go to drill down to the daily charts. But in any case, and this is for the dollar. You'll see it on a host of financial market sectors. In any case, this is the substructure. So this is my count, A, B, and then the 24th provided what I'm referring to as possibly a C wave. Okay, if it's the C, if it is that, now I'm not certain that that's the case, but let's say that is the case, then that would mean it's over. The 4th wave is over, and a 5th wave would begin. And this might be the 1, the 2, the 3, of this little degree or internals of that fifth wave of this set of 5 waves. You see, in other words, 1, 2, 3, 4, and then fifth 5 ostensibly or ideally or theoretically would be somewhere up here, let's say. All right, but then within that fifth wave, this might be the 1, 2, 3, and that brings us to yesterday's close. That might be the internal fourth. We might be at the fourth of a larger fifth, you see, or the fourth wave, yes, of a larger set of 5 waves itself. And so then what needs to occur, or what we would expect would occur to further serve or propagate a market moving forward as we move out into time, would be the internal fifth of a larger fifth, which once that completes, we would expect would mark the end of that move. So this is the weekly. Let's scroll down further. This is a little more detail showing or highlighting some certain what I feel are salient and important internal Fibonacci relationships that we want to look at. Okay, so again, showing the mapping and the smooth liaison here, or nexus, or points of dovetailing. If this is the bottom on 8/24, August 24, if it is, okay, this is the end of 3, and then what happens after 3? A fourth wave. All fourth waves should break up into 3 little waves, the A, B, and C. This is the A. This bottom here would be the A. This would be the B of the 4 and the C of the 4 on 8/24, confirming more greatly that in fact that larger degree fourth is complete. And here we are. Here's the daily chart. This is the March contract I printed out. We're going to expire in the December, I think, any day now, coming up this week. So we want to now look at the March contract of the US dollar if you're trading it. August 24 bottom. So within that, if that's the end of the C of the fourth, it's the start of a fifth wave. Everything to the right of this date at the bottom of your screen, the lowest price on the dollar chart, on the daily US dollar chart, this bottom right here that came in on August 24, in this count would suggest that that marks the end of a correction fourth wave and the start of a impulsive or motive fifth wave, taking the market higher. And I believe that brings us to where we are over here at the right, the last bar. This is yesterday's bar. Okay, and so within that, if all of this appreciation from this point to where we are right now is a fifth wave, what I've marked on this chart are the internals of that fifth, or or the structure that suggests to me that is consistent with that. This could be the 1 of the larger fifth, the 2 of the fifth, the 3. Now, why do I think that might be the 3 of that fifth? Well, here, if you measure from this move to here, and you take 1.618, if you can see that, I admit that's a Fibonacci level, that almost perfectly corresponds with that recent high there. That's why I did the count, or that's one of the factors that I considered in ending my third wave at the top you see on the screen, because it's pretty much a perfect 1.618 extension of the move from this bottom here to this top. So that makes a logical candidate choice as marking the end of that particular third wave. If it is, let's say that it is, and I've clearly just graphically illustrate my estimation as to how the waves are forming or tracing out on the screen on a daily. If that's the case, if in fact that's the case, everything since then, from the top here, at the point where I've marked number 3 through yesterday's close, is either an entire wave 4 or a portion of a wave 4. Granted, this could be the A, this could be the B, and yesterday's close could either be the C, or if there's more to come, time shall tell. We don't know. I don't know, or I should say, for certain. I have ideas, but that's one. I see structure consistent with either a completed fourth wave, possibly with the close yesterday. This last bar on the chart corresponds to yesterday's price action. Or it's possible, we know that fourth waves tend to be extended in time. It's possible that this is just the entirety of the move from the top here through where we are is either just the initial leg of a larger, what will ultimately in retrospect prove to be a more extended fourth wave out into the future somewhere. Here's your timeline down here. Or it's it is the fourth wave which has in its entirety already completed. That I don't know for sure. So when you don't know, a with perfect comprehensive certainty the full state of a market's present condition, much less its future position, we have to look and utilize various models and look for where the models seem to indicate the most probable, where they indicate you have the greatest likelihood or probabilities for an accurate interpretation. Often you get conflicts or contraindications when you see agreements and alignments or what we call convergences of output of view, then that tends to indicate either more strongly or less strongly that you should have a correspondingly greater or lesser degree of confidence in your viewpoint. But in any case, we want to consider varying arguments as to why a particular market should be assessed at a certain state. Once you have confidence in a current state of a market, you can have a commensurate degree of confidence in terms of how you can extrapolate or project that state out into the future, giving you a forecast or a view you can stand on, from which you ultimately could then construct a strategy from which you could exploit for profit. But that's further down the line. Analytically, this is why I ended wave 3 here based on that Fibonacci extension there. You can see the internals of wave 2, the A, the B, the C. It's kind of a morphing between a flat and a zigzag, but in any case, you've got internal here. I got C5 waves possibly here. You have an ascending triangle, very common in the 5th wave of a impulsive third. So a lot of or a number of different factors go to confirm this particular smaller scale count that I've presented on the screen. All right. This could be the A, this could be the B, this could be the C. Another factor that a later slide will indicate is I have a time target for this market, which was the 10th, which was 2 days ago, this past Thursday, December 10th, which is the second bar and not the last bar on the screen. If you can see that right there, I have a projected time target for December 10th specific to the US dollar. What does that mean? Those of you who've heard me talk about market timing, that's my area of research in particular, well, the immediate knee-jerk response or takeaway of interpretation is simply to expect a greater than average probability for change. One type of change is trend reversal. So it's not definitive, but it is a component of output of information that in and of itself would be potentially bullish in that you ask yourself, what's the market doing as it arrives at the projected time point? Well, clearly the net motion or trend has been downward. So to the extent we see the market arriving at a theoretically posited time point from above, you would expect it's more likely. It would have a greater than average propensity to stop its current motion and alter and move on a deferring track. Thus, that would be an argument as to why I'd be expecting a market to stop its decline and mark a commensurate onset with a reversal to the upside. It's not by any means definite or certain, though, but it's one point to the bulls, as it were. Now, I will already say if it worked like perfect, if the projection was embedded with perfect accuracy, we would have already possibly seen a beginning of that move. Well, yesterday's action relative to the Thursday was an outside bar. You had a higher high and a lower low. And also, I would have loved to have seen yesterday or even the day before as a key reversal. We didn't. 6 in one hand, half a dozen the other. Sometimes you get what you're looking for, sometimes you don't. The one thing I know analytically, you should never force or torture data. You must maintain a completely objective view in terms of allowing the market to tell you what it's doing, read its present state, and as such, that's a key in and of itself, not complete or comprehensive, but a step towards understanding more plausible tendencies of motion for the future. That's all. Anyway, we are at a point, I think, in time, given my time target and the amount of confidence I have on December 10th, the fact that if we continue to drift lower or sideways, well, the more and more, as the further out or past the time target for which I have an expectation for change, the more I interpret that the market is overbalanced its time has taken too much time in a particular regime, and as such it has stayed too long at that regime party and is more likely going to, in order to compensate and bring about an equilibrium between time and price, would serve to more quickly get back on the right track. And that would be my argument for expecting a reversal. The fact that this timing point, December 10th, the day before yesterday, this bar right here, if you can see that, comes in at a price point consistent with a reversal, is an additional feather in my analytical cap, as it were, or quiver, so to speak, that would more greatly suggest a reversal is in the offing. What am I referring to? If you can see this, there's a lot of data on, or information. What I have done is if you measure the distance from point 2 to point 3, that's wave 3 in this count. I've done it. I have on the one hand the 1.618 is a Fibonacci extension, indicating a theoretical target for where I would have expected 1, 2, and 3 to end up. It worked almost precisely. That's one relationship I want you to see from this slide. Completely different, but I expect complementary, is a fib retracement analysis that I've overlaid. It's a little confusing, but there's a point why I want you to see this and why it. Notice if you, you can't see that because it's 100% corresponding to the fib extension relationship in my attempt to project why I pegged this top here as ending wave 3. This is the 100% level. Overlaid on that, if you can see that there are actually two lines here at this level, that's 100, but it is also 38.2%. The 38.2% is the initial in a spectrum of fib retracements going downward. 38.2 is just not a perfectly overlap. That's the dotted line, and if you can see the solid line. The solid line refers to the 100% Fibonacci extension going upward with reference to this point number 3 projection. The dotted line is a completely opposite. It's the initial 38.2% fib retracement, 50% being the next one, 61.8. In other words, trying to indicate the extent to which I can project how far the fourth wave will go. Very often, 80% of the time, fourth waves do not exceed the degree of retracement in excess of 38%. Well, notice the B wave, or excuse me, the A wave, exceeded it. The B kind of corrected the correction, if you will. The C went out into new price territory insofar as the correction is concerned. And notice where we are. Yesterday's low, the day before, or excuse me, yesterday's low, 2 days before, that's Wednesday, perfectly respected the 50% Fibonacci retracement level. These three numbers, 38, you can take my word, that's 38.2 fib, 50, and 61.8, are the three Fibonacci ratios most integral and central to doing retracement analysis. Those of you who understand a little more deeply know if the market breaks through, then the next one's 78.6, but these are the three critical ones for our purpose. The whole point that I'm bringing out here, I don't want to make a mountain out of a molehill, is the close proximity of what it's not coincidence that the market is center of gravity in this entire move, if you will. A little more nuanced detail here. Notice it's revolving. Notice yesterday's top. Notice the day before, it didn't quite get it, but perfectly, yesterday's top reverts back to the 38.2 Fibonacci level. In a sense, it's acting as a gravitational attractor to the price, if you will. It's not coincidence. Now, granted, close was down in the lower third of the range, so it didn't close there. There's not a consensus. I got to be objective. I would have loved to have seen a key reversal type structure. Haven't seen it yet. It is what it is. You see, I would even go so far as to say that the reason the market did close lower is it is discounting the likelihood that the Fed will not do what this dollar would like to see. If I can anthropomorphize the financial market, in other words, if the market wants to be strengthened, and how can, in an obvious intermarket fundamental sense of thinking, a currency be strengthened? By decreasing, by creating a lower money supply, by raising the rates. So, but we didn't get that. And so the market is discounting the possibility the Fed will not raise rates sooner rather than later. We're not going to see a rate hike this Wednesday, let's say, or this week. And as such, it's settled at the lower end of the range. I'm not saying that's just a point, a very finer point to consider. In any case, it's not coincidence. This 100% is a very important level, and it's one and the same almost. If you can see the spacing there, it's almost the same, that overlap. That's not coincidence. Notice this is a close overlap, but that's pertaining to the end of wave 3. What I'm talking about now is a little more central to where we are more recently, the most recent activity. And I'm also trying to determine with greater certainty if or whether or not this correction is complete. What percentage of the preceding third wave have we retraced? Where are we in that progression of motion for this system? And to the extent I have certainty in that, I get a finer sense and can trust more or less completely in my projection for the future. But in any case, I have two completely different types of information. One based on the horizontal dimension, time, the other based on price. Both very different origins, different in nature, which happen to be coalescing and generating a similar, plausible, and a mutually agreeable conclusion. That is, that it's more than average likely that we're ready for a change. Now, not a reversal, a 180-degree shift of trend direction, up to down or down to up, is not the only type of trend reversal, clearly, but it is one. So if I see a setup on all fronts, time and price, indicative of that, it does cause, I want to be aware of it. I don't want to discount it, is what I'm saying. All right, so that's the essence of what I'm showing. Now, another final point. Assuming we are at assuming the low yesterday and Wednesday, these two lows, or the area of 50%, Fibonacci 50% retracement of what I'm considering to be possibly a fourth wave into the preceding third. If the lows are in, then that allows me, based on the internal fib ratios of the cycle, 1, 2, 3, 4, 5, to make a theoretical forecast for where I would expect the fifth to end up in advance. Here's your 61.8. How did I get that? Just those of you. I took 1 through 3. You measure that. You take 62% of it. You run that distance off of the pivot point bottom. That brings you over to 102. So already I've worked out hypothetical projections as to where I might expect, if I'm correct, if we have very little, if any, further downside in the U.S., and we move up from here in what would be the onset of a fifth wave, the ideal theoretical is going to bring us just to above the 102 area, 102, 102 and a half, etc., based on where we are currently in the U.S. at our current price of around 97.60. You see, you can't see that there, but we settled yesterday at 97.60. All right, so that's giving us a potential range of what would be conservative. Well, at fifth wave, we know fifth waves are truncated frequently, but that's a theoretical, right at this level here, based on, I have nothing to lose and everything to gain by constructing or generating that idea. All right, let's move on. This is a rotation in time idea. These are the past through the present and out into the future. These are amazingly accurate based on all of the varying models that I incorporate to generate time targets. This is specific to the US, to the currency. March 15th was a theoretical. The actual top came in one day later, the 16th. This is the history, a continuum of rotations. Do I place trades and establish decisions and act much less positions in markets solely on this? Well, I don't know, but here's the idea. It generates, if nothing, more or less a roadmap in time for which I then look and see, do I see corresponding price action that would fit and make sense in the context of what the rotations are suggesting. Remember, relative to a concept that I am a big believer in for all financial capital market sectors, a market's going to do what it's going to do only when and once its time has come. Not everyone believes that. That's just a tenet of a type of analysis that I apply to all markets, and is certainly a major currency. So we had a rotation. By the way, these dates don't in any way intrinsically give us information, unless they do in ways that I am not aware of, about price, whether even in fact, to the extent a market responds to and is sensitive to any future projection or any past projection or any projection in time. I don't know at the time I generate this data whether or not, even if it proves to be accurate in retrospect as a turning point, whether it would manifest as a turning point that would form and look like what technicians call a top or a bottom, points of supply and demand from an economic viewpoint. But what's important is we understand as we approach these points at or around, we have a greater than average anticipation that they will correspond to some type of transition or phase change or mode of behavioral difference. Okay, so March 15th, the actual top came in a day later, on the 16th, I remember. April 29, the bottom was 1 day. This was the next, that was a bottom. It wasn't, I don't know whether it was tradable or not, but it was nevertheless 1 day prior to, in that case, all right? This one, not so significant, June 13th. I think I put that line right on the turning point, so it was not, I would consider a hit. So these two were pretty accurate, very accurate hits to 1 day. This was more or less not what I would consider a tradable or viable. It was more or less in the midst of a trend. So I'm not going to consider that as a good hit. It's less than accurate. Overall, this is going to work 75% of the time. Right, confidence of expectation. August 6th, 1 day early, accurate. Look at that. That's the top right there. I purposely, my forecast, this was, yeah, or no, this was perfect, I recall. I put the vertical line so you could see the top that came in, the 1 bar, it came in on that day, perfect. 9/11, I was 1 day, that was accurate, that was perfectly accurate, but I don't know, you can see the move, that the magnitude of the move subsequent, I don't know that it was tradable, it was a 3-day situation there. September 11 of all dates, and the one that I just mentioned from the previous slide, 2 days ago, Thursday, December 10th. So what does that suggest? What is the market doing as it came into December 10th? Clearly a predominant trend for the last 3 days, the last 5 days, etc., down. So it suggests to me the greater proclivity on the part of the market to change its character in some way, shape, or form. That alone, again, this is out into the future. My next major turning point I have already projected for the US dollar is March 9th. Curious, because that reconciles with some other dates for some other correlated capital financial sectors that I've already worked out. I'll talk about that in a minute. I have another well, there may be a few other dates. These dates don't in any way specify or do not suggest, there's no implication that markets cannot turn on dates other than these, let's say in the interim, necessarily. All they say is on or about these dates, we have a greater than average expectation for, say, trend reversals, to simplify the thought, to occur. There's another date I'm going to talk about when I discuss in a few minutes specific entry ideas that I didn't include, because these are the more macro global patterns of rotation that I'm expecting. But again, the point I want to take away from this slide, at the present, is given this date, the fact that we're on a weekend, I discount that. If we were to eliminate and discount Saturday, today and tomorrow, that would suggest sooner rather than later, I expect some type of change. Now, in the broader of senses, change doesn't always mean a 180-degree polar shift of direction. It could mean a change of velocity. Some attribute or feature or component of the market's behavior affects a shift from one neighborhood of motion to an alternate, that's all. But certainly one subset of that is an outright reversal of trend. So that would be an argument. The fact that it's coming in looking at a price point that's based on Fibonacci internals, as the preceding slide suggests, indicates it's ripe for a reversal or a change of some sort. Now, here's an argument, just so I didn't want to, let me go back, so I'm not glossing over and trying to pull the proverbial analytical wood over one's eyes. If I look at that and say that this is the A, this is the B, the C, it's, we get into the area where Elliott model analysis says, oh, your ABC correction is typically going to be bounded by the preceding wave 3 and 4. Well, clearly it meets that condition or criteria. This would be the end of the fourth over here from a price standpoint. From a time, it's over here. But certainly from parameters of range analysis, this is the bottom of the 4. This is the top of the same bar as maybe the end of the internal little 3 here, the 3 of that little 3 going up, the internal 3 of the larger 3. You see, this is 1, 2, 3, kind of 4. This is the end of the 4 from time, but from a price, it's one and the same. And then this is your 5th of the 3rd. And then this is the, going, and that in itself breaks down. But you can do it ad infinitum. So what the point I'm making here is that on the entirety of this move here to here fits kind of midway, the 50 between that range. So on that note, it does suggest more likely that this in fact is a completed. That would be a vote of confidence to suggest that the entire ABC correction, the fourth of the larger fourth, is in fact complete. However, here's a counterpoint to that argument. If this, I ask myself, does this look like a flat? Does it look like a triangle? Does it look like an irregular? Does it look like a zigzag? It's most closely resembling a zigzag. A and C of a zigzag tend to be equal. If I measure the distance from this top to what I consider to be the end of the A, this, clearly we have not traveled that distance on the C. A and C, the C wave is much shorter than the A. So that would suggest further declines, possibly down to the 61 or even later or greater. But that would violate or be out of sync with some alternate conditions, but it would in turn allow a closer correspondence to that idea. The principle is as to how we would expect theoretically a zigzag looking formation. So, pick our poison. Sometimes and rarely do I get everything aligning, but that would be an argument that an astute technician or analyst or observer would say, aha, Glenn, if you measure this number of distance down to here, that's the A wave, and subtract that same distance from here, you're going to get down in here somewhere. Clearly, we're not, so from that vantage point. So that would be an argument to suggest further declines. It would also, from a reverse engineering standpoint, if you think about it in terms of, suggest that the Fed is less inclined to raise interest rates this week, sooner rather than later, would be my thought. If that's the case, that presumes that the market will necessarily respond or be buoyed up and be bid up on a rate hike and would be pressed down or offered lower if we don't decline. That's an assumption. That's not gospel. We don't know that for certain. But on that assumption, but in any case, I am playing the proverbial devil's advocate by saying I'm not saying that everything I'm looking at is guaranteed to push and bid. I'm not saying that I have complete comprehensive across the board evidence suggesting this correction is over. I am aware of, I try and look at everything possible, but in the scheme of things in the net, I believe I have a greater preponderance of evidence to suggest that the correction is complete. And as such, we are, if not at, almost there at the point where we can expect an onset of a resumption to the move higher. All right, and the rotation count in time confirms that. This is just a quick overview of a preceding interconnection slide, and specifically kind of showing and highlighting graphically so we can kind of get it in our heads, different sectors, and in particular, so I think I did this when I was talking, this was a slide that I presented some months ago when I was going over the interest rates, and you can see the same relationships hold as a norm, as a starting point. So here, if the dollar, instead of switching from the perspective of the bond market, they're closely related, as are all these others. These are the primary financial sectors: interest rates, the currency, the stock of a nation state, if you will, energy, oil, clearly pivotal. You can make the whole planet revolves on that primarily, so it's integral to everything. Metals in turn, and equities, of course. So if the dollar goes up, as I am proposing, at least for the next few months, it will, regardless of whether we get a rate hike this week or next month or at some point in the first quarter or at any point next year, 2016, then I would expect pressure on bond prices, lower oil, which I do expect, lower metals, and 2016 I think will be, just for the record, a catastrophic, well, I don't want to say, it's not the, I don't believe it's the end of, I believe it could be at some point next year, 2016. Let me state this explicitly. It's going, I believe we will see the end of the generic bull market in stocks. I don't know exactly when. I will say this, correlated to the dollar. I have a very critically, high confidence in my time point for the middle of January for the stock market, January 12th, January 13th. The traders that I consult and teach and work with and on day-to-day basis, no. I have my next, I mentioned earlier today, the outset of the presentation, to put all of this into context, specifically with regard to the role the US dollar should play in my estimation. The stock market will turn on or about from the middle of this week, but my precise projected turning point that I've worked out is December 18, this coming Friday, a week from yesterday. I believe what could act as a trigger is whatever action or inaction emanates from the Fed meeting this coming week. Whether something of significance occurs from the central bank action or inaction is irrelevant. The stock market will turn between Wednesday and this coming Friday. It's over 95% confidence. Is that a guarantee? No. An options trader told me years ago, never confuse impossible or possible with impossible with improbability, or guaranteed with highly probable. I don't care how highly probable something is. It could be 99.999%. It could be a light year away from guaranteed, or the opposite. So I am crystal clear on that. I am saying in the high 90 expectations on a scale of 1 to 10, I am just under 10 in terms of expecting a change in stock in the broader U.S. stock market to occur by the end of this week. And that could be precipitated by, and I expect a correlated move in the U.S. currency, the dollar. Whether it's action on the part of the Fed and or something else is of lesser concern. The Fed meeting this coming week is of great interest. Yesterday, I guess the scapegoat for the falling stock prices was declines in oil. If it hadn't, I always tell people, if it hadn't been that, it would have been something else. I am projecting further declines in energy. And it's why I'm in the midst of updating my projections on that. As we move out into next year, I'll probably be talking a little more about that in detail. But for now, again, if I'm wrong, if the dollar goes down, I'd expect further rises in interest rates and a basing of support in the commodities sector in general, and continued appreciation in stocks. But I don't see that. Moving out by the middle of next year, certainly I expect the pattern of relationships that are more likely going to be evidence in a bigger picture graphic way to be reflected by the relationships on the left side of this page. All right. Here's using the interest rate. This is the bond market, 30-year Treasury, to predict. This is my wave count recently for the bonds. 1, 2, 3, all of this little triangular pattern. If it is, I'm not certain on the bonds either. So there's some uncertainty commensurate, because is this a triangle or is it a flat? If this is the end of a flat, then we're in a new bull market for the bonds. Let's go back one, just take a note. I don't expect that's the case. I don't expect. What is our relationship? Typically, knee-jerk, in a vacuum, at least as a starting point. Higher cost of money puts pressure on nominal treasury prices. Lower cost, there's an inverse relationship. Good news is bad for the bonds. Bad news is bids the nominal price of the treasury up. But just to show, so that would cause me, that's the fundamental consideration. These are the technical, or a component of tech. This is one form of a technical interpretation or appreciation. So that would lead me to, that might suggest, in either case, whether this is an A, B, C, D of a triangular fourth wave, and this is the E, or if this is just a flat that's already completed, and we're already in the fifth as of this bottom here, in which case that would make that a 1 of a new bull market. This would be a correction 2, and this would be a 3 or a 5. You see, in either case, these two lines reflect my next projected time points for the bond market. This is out the end of December. I can't recall. I think it's due around December 29, and this is out middle of January, out for the bonds. In either case, immediately I'm expecting a little appreciation in accordance with either of these two wave descriptions, but as the preceding slide indicates, once we see, if and when we see a rate hike, once that actually, however, to whatever extent it is internalized by the interest rate market, I expect that you'll see pressure and you will start to see this phenomenon, the bonds coming down, assuming this scenario that for the US dollar plays out. All right. And that's why, and that's the bet, that has primarily characterized the long-term fundamental bet on the part of the bond shorts, the traders that are bond. This is just a temporary correction. I think we will see a resumption possibly with this, the end of this month. We may see a turning point. We may rise into this turning point corresponding to the 29th of December, at which point we will see a resumption. This could be a fifth wave and then an ABC correction ensue, consistent with the preceding relationship that this relationship this slide showed. Yeah. Right. This is the getting in. This is the how to exploit this for practical purposes if you're trading. This is the US dollar chart. This is the March contract of the currency. And here's what I would do, the specifics as to the strategies, and so forth, I don't have time to elaborate on. These types of things you either know or should know or must learn to do this correctly. But in a qualitative sense, to give you some generic sense as to how I am thinking about exploiting this. Where we are, this is just the daily chart of the March contract. This line here, this trajectory here, will be my entry line. It's my line of support from which I anticipate attempting to go long the market. In other words, at any point if we see as the market respects or hews to this line, it's the zone of support, and it's dynamic in that it's adjusting through time. As we move forward through time, the support is decreasing, you see. And so if at any juncture I'm getting long, this is a line below which I would expect the market not to tread, which if it does, something is out of alignment with my analysis. Get out. That's where you'd put your protective stop, or that's where your point of exit would be if you're in a long position, dynamically speaking, a little further out into the future, based on where we are currently. If at any point we establish our long position, this is a target line. This is a projection as to where we would expect it to go. Again, remember this target up here, 61.8, if the analysis in the preceding slides proves to be manifesting. If we see it forming and looking like I expect this to be a theoretical attractor to the market. And notice that this exit line is moving and approaching and gravitating to it, as I would expect. So I'm seeing a few different things. This is a time point that I had not indicated on my time rotation slide previously, because it's very specific to the entry and or the exit based on a completely different type of model that I'm using. But it's nevertheless an interest. December 24th. It just occurred. I just realized that's the day before Christmas. How the lower volumes around holidays, I don't know. I just go with the numbers and the data. That's all. But here's how I would be thinking. That's using this line as a point of understanding where critical support dynamically will be moving, and how you can expect if at any point you establish let's say a position, in this case long position. I'm talking very specifically in terms of setting up creating or operating or thinking within a set of parameters that would determine the state and any and all relevant adjustments one might make, assuming you've established a long position and how you might establish it, and once you've established it, where you can look to extract or profit so as to extract the most favorable return characteristics of a play. This is the range between the 38 and the 62. This is the range within which you want to play. This is your wiggle room. A conservative trader might look to wait until we break out above that level before establishing your long. A more aggressive trader is going to be looking for a deeper degree of pullback from which they can buy it on a limit at a lower price. But this is the range of opportunity between the 38 and the 62 keeping in mind this is, we break down below this line, wherever it might be at any given point, all bets are off on playing the long side of this situation. If, however, you get in, or you at any point, however, you get in within this range, I think it's viable. A conservative trader, again, may choose to wait for a break above the upper region, the zone of resistance indicated by the 38 fib level, and then keeping in mind that this is your profit or exit or scaling out or adjustment line on the positive side. The idea, ideally, this is, you can see that this line is being attracted to that theoretical area or zone of where we would expect the fifth wave in the wave count would fall. So that's a little more detail in terms of the context of parameters that I'm thinking about by which I might begin to formulate some type of strategy relevant to my expectations in the dollar. Oh, this is just a rehashing of the previous. Folks, are there any questions? That concludes my thoughts. Again, this is just a reiteration of what I mentioned. Peter Newman, head of admission. If you want to reach us or find out in more detail what I think about and how I construct and do some of the things that I do, or any questions related, in 34 years, I have a familiarity with most generic things or types of analyses and forms and ideas. I can't claim to be expert in everything, clearly, but I've seen many things. I don't use all of the things, but if you'd like to get greater detail concerning anything, you'd want to contact us at the contact information seen on the screen, pacifictradingacademy.com, 1-800-339-8588. Peter Newman is the liaison in that capacity for that purpose. Any questions? We'll take it to the videotape here. And let's see. Oh my. Hopefully I do have a few minutes to, I should have. Oh boy, I didn't realize there were that many questions. Normally, I guess, at the end of the year, oh, thank you, Vijay. What gifts? Well, hopefully the profits we will accrue in our long positions in the dollars. I establish everything. I think that will be the gift. I think there's very high probability for appreciation. I am very bullish. So just to rehash and reiterate and embellish all of the preceding goes to indicate, I send out signals for the traders that I talk to, and so I only do that assuming I actually establish a position in the accounts that I'm trading. So everything you just, I'm not long in the dollar yet. I am indirectly long I trade Forex. So in the yen and the euro and the kiwi, etc., I am in and out on varying time windows, short-term, long-term. I enjoy all of the above. But whenever I send a signal to the traders that I consult directly, I only do so if and when I have established a corresponding position. The specific strategies are individual trader specific, as they should be. They should reflect levels of resource, levels of tolerance for different amounts of risk, particular stylistic proclivities, etc., etc. There are a number of variables that will more finely differentiate one approach and strategy that would be most favored considered in the context of what your projections are and how you choose to exploit it. You may be an options trader, you may be a shorter term horizon trader, you might be a longer term, you might, so all of those details, I certainly don't have time it's too much to get into for now. I just wanted to present more of a graphic, global, macro view of my expectations and plausible scenarios as to why that should pan out or manifest. So let's see if I can get, if there are any questions I can get to. Okay, yeah, I expect a considerable appreciation in the U.S. Do I see S&P has support at 1993? I am short. I've been short. I'm short in the S&P at what are we? 2062. I moved my stops down twice yesterday to 2027. I don't. Ooh, sorry, Vijay. I don't off the top of my head know where the support is. I'm not looking at the chart. That's easy for me to find out. If you want to, if it's important, contact our office. I don't recall off the top of my head because I got some numbers in here in front of me on a sheet of paper, and I just don't remember where the critical support is. I'm just straight. I got short 2 weeks ago, because you may recall I had a time point for the stock market on November 23rd. That was right a few days before Thanksgiving. Things got delayed, and the market fell down, started the following week. So I was about a week early on that, and I think due to the holiday, that's why I'm always cautious around Thanksgiving and Christmas in particular, because volumes decrease and you have often there's a delayed effect of what otherwise at alternate times in the year works more. There's a closer tracking and mapping and a higher degree of precision with which some of these things occur. Nevertheless, the support, I think 1993 is, but I don't want to say for sure because I don't recall. And I looked at it. I was looking at the charts in preparation for today's presentation earlier this morning. I just don't recall the importance or lack thereof of 1993 in particular. That's easy for me to figure out very quickly. If you are interested, if it's critical, contact our office, and then I can, through Peter Newman, get that to you. I can let him know, and he can tell you my thoughts on 1993, clearly. Sorry about that. Normally I have that in my head, which will be in harmony. Here, just one thing I will tell you, I wouldn't be surprised. Well, I don't want to say that. Up until what happened yesterday, I would have said we will be. Here's my thought: stocks are going to decline into the end of this week, coming week. After which, I expect the market to rally, quote unquote, the Santa Claus rally into my exceedingly important. I cannot emphasize how important this is. Middle of January, January 12th and 13th, and so I currently am projecting the middle of January, those two dates or thereabout, to mark a significant top in the stock market. Whether it will be a new high, are we going to see new highs? Are we going to take out the highs of May 19th and July 20th by the end of the year? Prior to yesterday's trade, I would have given that about an 80% probability. Depending on how far we move to the downside, based on my expectations, where we end up by the end of by Thursday, Friday of this week, I'll know much more with greater certainty whether or not we will break into new highs in stocks before the end of the year. Again, prior, a week ago, 2 weeks ago, 3 weeks ago, 3 months ago, I would have told you we will establish new highs. The 5th year of every decennial being the year of ascension. There's 87% track record going back for 200 years in stock markets worldwide for the fifth year of every decade for ascension. The sixth year is a catastrophic year for stocks. So I'm not saying the bull market is over yet. I'm not saying it will even be over with my projected time point middle of January, January 12th and 13th. I do expect that to be a major top though. If, I could be wrong, but I don't doubt that. And so I still see a major rally into the end of the year, depending on whether or not it's going to be a new high or just rival and test the previous highs that came in on May 19th and July 20th, depending on which index you look at, will be a question or a function of more precisely where we end up, say, by the end of this week. So ask me once I know, this time next Saturday, I'll have a keener sense as to whether we're going to, in fact, reach or achieve new highs, or will we just retest the old highs that have already been put in. In either case, I expect the market, in all likelihood, I'll go so far as to say I think we'll be higher at the end of, December, last day of the year, December 31st, than we were at January 1st. Okay, so I'll go out on that limb. All right. Someone's saying 1990. Do I see support at 90 and reverse for upside, which will be in harmony with the US dollar, also reversing in a week or so? Yes. I just don't remember the 1993 number. Do I see support at 96.45 for the US dollar? Yes. Yes, certainly. Clearly, if we're not already there, relative to some of the slides that I was showing, yes, clearly. Major support there. We are at major support. Let's see, someone's asking, international markets, commodities like oil, gold, etc., are quoted in US dollars, creating demand for US. Yes, going higher. I remember vis-a-vis the correlation or connection sheets and intermarket relations that the previous slides. Yes, in general, because oil in particular is, priced in dollars. As dollars go up, that will buy in and of itself. It's not, there are other factors. But, Saudi, OPEC, we're increasing. Here's the idea. OPEC is increasing production. What are they up? 31 million plus barrels per day. Even though there's internecine confusion among some of the other players within OPEC, OPEC is still calling the day. Lower global demand. I'm expecting the slide in energy to continue. I was not as bearish as I was a month ago on energy, but in consideration of the technical structure of oil and other commodities in general, the intermarket correlation, the idea that oil is priced in dollars, certainly that augurs for lower oil prices and higher dollar prices. Certainly that relationship is strong, and I agree with that. Going down, yes. Less demand for the US dollar, making go down. On top of that, China's yuan is now reserve currency. Yes, yes. Yes. Someone's asking, do I think the dollar range or dollar will be a dominating currency internationally for some time? Yes. If you're asking specific, is let's see, I was trying to read this. Less demand. Oh, I think the gist. Someone's saying is if there's less demand for US dollar going down on top of that, China's yuan is now reserve currency. I think what they're saying, would that put pressure on the US dollar because of the increasing dominance of the yuan? Good question. I think Vijay or whoever's asking, the thought there is, remember, I'm going to say out to the middle of the year. If that phenomena kicks in, I'm not expecting it to do so before the middle of 2016. So everything I've said in today's presentation really is, it's related to, I'm talking the first to the second quarter out into the next year. Beyond that, I'll have to reassess. One of the challenges of forecasting as we go further and further out, it gives greater time. The longer the range of anything that's nonlinear, such as the relationships that we're talking about, currency trajectories, there are nonlinear elements that decrease the degree of certainty with which I have. So the further out into the future, the less certainty I have. So as I get more proximal to these events, I'll be in a better position. So certainly the obvious relationship between China and the US and their respective currencies is a changing one. It's dynamic. I don't foresee a transitioning in a wholesale sense between renminbi or yuan and US before the middle of next year. After that, all bets are off because of the nonlinear components and the capacity or potentiality for the era expansion, the butterfly effect, so to speak. But as we get more and more, as I see more and more, if I'm confident going out about a month to 3 months maximum, but even there. But when you break out beyond more than 3 months, the degree of error and the state changes that are probably going to have occurred just introduce levels of uncertainty where a forecast becomes diminishingly or increasingly more undependable and unreliable. So we'll assess that, but basically I seek and project continued strength at least for the next 2 to 3 months out in the US, that is. But certainly the relationship between the US and the China currency are going to be of greater concern as we move forward, certainly by the mid part of next year. Folks, it's been a great experience. Hopefully you got the so-called Santa, your gifts for the holiday season. Until next time, I wish you a great weekend, happy holiday season. I won't be doing any programs until the new year, so happy new year if we don't talk, and most profitable opportunities in the market to come. Look forward to talking to you then. Thank you. Thanks again, guys.